The spirit of innovation is deeply ingrained in America, and Google is helping Americans innovate in ways both big and small. From improving emergency response times to protecting against cyber attacks, local, state, and federal governments are innovating with Google AI. This is a new era of American innovation. Find out more at g.co/American Innovation.
Reality radio for a really great future. We're talking real money.
There's something to be said for flexibility. You know, we all should have as a matter of fact, not just the right to, but we have an obligation as people who, particularly us, give advice on the radio or on podcasts, to change our mind as we are presented with new information. We should not get locked into a position just because we believed it before. If that was the case, I'd still be telling you to buy individual stocks and overpriced mutual funds at Dean Witter, which doesn't exist anymore. It's Morgan Stanley. Or I would be giving advice like I pretty much believed up until 2001, that people were capable of investing on their own without spending a lot of money for help. Well, it's nice, it's refreshing when somebody can say, I've changed my mind, and then give you the reason why they changed their mind. And the reason we're talking about this is because somebody we enjoy reading, and we think her material is very good, Christine Benz at Morningstar, basically said, I've changed my mind.
She likes us now?
No,
how far does this go? Not that far.
No, not that far. I don't know. I mean, it's you that's been getting spurned by her, not me.
I'm hoping we can change that. Yeah, no, I have been accused of being intractable.
Oh, you really?
Insufferable.
Let's go back to intractable. Let's just spend some time on that one.
No, we don't
have time for all your other flaws. Let's stick with the intractable one.
Yeah. So she brought this up. By the way, I looked at my situation and come up with a few things I've changed my mind about, which we'll get into in a moment. But her three, which I think is fascinating, are, she calls them retirement-related matters I've altered my thinking on, either because I was off base in the first place or gained new information along the way. The first one is the do-it-yourself model for retirement.
That's the one I changed on.
Yeah, I know. She says, well, I wasn't anti-advisor, but I reasoned that putting together a sane portfolio of mutual funds isn't that hard. What I underrated is that financial advisors do much more than portfolio management, or they should. They help clients articulate, quantify their goals, stay the course in rough markets, minimize tax bills, to name just a few of their jobs.
Now, interesting. Just a couple of weeks ago, I interviewed one of the folks at Vanguard who wrote the paper on the value of advisors, how much they tried to quantify what she's talking about.
Yep.
How much more money can I make if I use an advisor? And this is one of the reasons I changed my tune, because advisors make you more, at least have been shown to, based on these studies, make you more money because they stop you from doing dumb stuff.
Well, now, these are the right advisors, too.
Right,
these are investment advisor representatives that work for registered investment advisors. These are advisors that you...
solely fiduciary, by the way, because we've run into, when we talked about the university, and the investment advisor behind that university has another group that doesn't act as a fiduciary. It's so easy to game the system.
That are planning-centric, that use low-cost products, all the things that you have to do in addition to just being an advisor, because there's a lot of advisors. But this is one that we've come around on this. We have been strong do-it-yourselfers for a long time. When I had the TV show, I still was. But we've seen too many mistakes made, seen too many problems that have come up as a result of that. And frankly, once you get close to retirement, things just get more complex. When you're saving,
that is really the key. Yeah. There you nailed it. Early on, when you're 22 years old or 31 or whatever, you're putting money into a 401k, it's pretty easy to pick the right portfolio.
Yeah.
You generally go for the lowest cost, best diversified growth vehicle available. But later on, when you start getting closer to retirement and you've accumulated wealth, one, it hurts more to lose it because you spent a lot of time making it.
Yeah.
And two, you start to worry about what your life will be like when you're unable to work.
Yeah.
And all of these things require, for most people, I'm sorry, I know you're smart in so many ways, but for most of you, you need a helper.
And again, the complexity just goes up. All right, the other one she mentions here is all-in-one investments for retirement. She writes, I've always loved all-in-one investments like target date funds for people saving for retirement because they outsource asset allocation to professional investors and consistently rebalance back to the target. Those are jobs that individual investors often struggle to do themselves. They don't have the time. They're not sure how to do it. It can also be psychologically difficult to rebalance because it entails cutting back on winners and buying into whichever asset class has recently underperformed. She says she's been lukewarm on all-in-one funds for people in the decumulation mode for several reasons. One, because of variations in non-portfolio cash sources, retirees' ideal, et cetera, et cetera. But she's concluded those objections are fairly minor relative to the positives that target date funds bring into retirement, especially for retirees who continue to manage their own investments. If you do it yourself, target date fund, probably okay, is what she's saying.
Sounds to me like Christine and I are like financial advisory siblings.
Pretty close.
You know, because I thought the same thing. I'm going, they're just one size fits all. They're not going to work for everybody. And the fact is they don't work for everybody. But what they do is better than not doing it at all.
Well, or doing it wrong, which
Badly,
people can do really poorly. So, and I'm another guy who's just come around on target date funds in general. By the way, today, it's like 65% of 401ks are in target date funds, which I think is a good thing.
Yeah, I mean, even Paul basically says target date, throw in a little small value.
Yep,
done.
Exactly. So, I was always the guy that I didn't like them because they tell you what your asset allocation should be based on your age and nothing else. Mm-hmm. You have no idea what this means to you emotionally, and we see people make mistakes with that.
However, if you know a tiny little trick to game the system, you can make it more specific to you and still get on that target date glide path where it becomes less aggressive with time.
Please.
And that is by determining your risk tolerance, finding that portfolio allocation that fits it, which, by the way, we do with the risk quiz for free, and then tweaking it. So let's say your retirement date is 2035, but you're more aggressive in your approach. Your risk tolerance says, I can be more aggressive. Well, then maybe you go out to a 2045 or a 2050. To start. You start a little further out because it's going to be a slightly more aggressive portfolio, but it's still going to slope down to more conservative over time.
Yeah. Okay, careful, because remember, we looked into this. Once you retire, it stays the same.
It stops. You're right.
It doesn't go any down anymore. It simply, what did we find? That stops at about 50% stock.
It's about a 50-50.
Yeah.
Whereas we sometimes in our individual portfolio advice we can take you down to 20 or 30 in equities if you're very risk averse. And again, that's the downside of target dates.
They're stuck there.
Now, I don't like this third one. I think this
third
is a waste. It's a waste.
It's not just that. It's just that I know most people either can't or won't do it.
And it's a minor matter.
She calls it a smaller bore issue. I think that's fair.
Really, you think? Yeah.
She's changed her mind on using individual Treasury inflation-protected securities rather than a TIPS fund. Now, these are securities issued by the U.S. government that, for lack of a better way to explain it, readjust according to inflation. The idea is to protect you against unexpected and unanticipated
the rate of inflation basically in lieu of a big chunk of interest.
Yeah. And if you buy your own, well, yeah, you can do a little bit better with a ladder of those than you could in a bond fund.
Right.
Sure.
Right. But we've changed our tune on tips in general.
Yes, we have. Yeah.
Because there has been a lot of work done over the course of many, many years, decades, that has shown that equities tend to provide a very effective hedge against inflation.
Yeah, well, companies raise prices.
They have the built-in ability to adjust their their revenue stream for the ravages of a less valuable currency.
And again, with a properly diversified bond portfolio, yeah, mostly U.S. government, but then you trickle in some higher quality corporate stuff. You get a little international. It gives you some protection in a big picture sense.
Not really as much from inflation. That the bond part, but when you have both, the bonds give you the stability, and the stocks give you a little. They give you growth. They should. They better, but they also do add an inflation adjustment.
Yeah,
that I think is adequate.
No, so
for most,
I think it was. She had to fill the final page. This is my take.
Yeah. Gosh, we're not to 750 words yet.
And by the way,
I need another 250 words.
When I read this, I already mentioned the fact that I came around on target date funds. I was not a fan 20 plus years ago. The other one that I think people get stuck on, because I still read it all the time, is the 4% rule.
Is that in there?
No, these are my things that I've come around on. I used to be a big believer in it. 4% always works. Well, first of all, no one knows what's going to work. It has worked. Number two, I think after you're, dare I say it, like 70 years old, you're getting Social Security, all that, spend your money. We tell people this all the time. I can't spend. Yeah, you can.
Yeah.
I mean, after 70, frankly, how many more years you got? Not calling you old, but
this is why I took Social Security at
69.
Right.
Yeah,
this is literally why I took it.
I think people get way too caught up in rules of thumb around things like that. Let it go. Spend your money. Enjoy your life. Get on with it. Yeah. That's why I take it.
Because the older you get, the less you feel like enjoying it.
Well, and fewer days ahead you got.
Yeah.
Yeah. I mean, like when I was walking
it's like
around
my
Europe,
mom. She's 89.
Yeah.
And she can't do a darn thing with her money except pay the nursing home she's in.
I know. So it's not really.
Thank God for my Apple VR thing. It is going to save my old age. I'm telling you.
I'm going to come over. We're going to sit there.
Just slap me under a headset.
Watch something.
Yeah, I'm going to watch the sunset on Maui.
There you go.
From my nursing home.
Now, you mentioned something interesting a couple of minutes ago about the value of an advisor that Christine Benz has come around to see as well. Mm-hmm. Vanguard, as you point out, has done an Advisor Alpha study where they've actually looked at what an advisor can mean to you from a dollars and cents standpoint, which is, and by the way, it's there's no guarantee of that. But Vanguard's expanded all of that. They did a survey where they asked 12,000 clients about what an advisor really meant. 86% of those people surveyed, 9 out of 10 said greater peace of mind, which I think is huge when it comes to your money. But also 75% said the advice saved them time, typically 2 hours a week. That's 100 hours a year.
People are really thinking about their money 2 hours a week?
Well, they're thinking about it more than that. They shouldn't be dealing with it more than that, though. That's a ridiculous amount of time.
It's like a lot of work.
Yeah, it is a lot of work.
I'm in the business, and I don't know that I know I do because I'm reading about it. But
this is the emotional time and value of advice study, which you can go read yourself. I think it's up online now from Vanguard. But it makes some very good points, Don, about the fact that money is generally more than just the money. It's around the emotions. It's around the care of that takes up space.
It's much more than money. I mean, really, what's the number one cause of murder in the world? It's probably money.
Well, divorce.
No, but it's usually over number one cause of divorce. Yeah.
Not murder.
Yeah.
Sorry. Well, okay. No, money. Yeah, it's at the core of many problems. But again, with proper advice, proper guidance, dealing with the emotions around all this, way, way, way different situation for those people that do that, I think. And again, this survey from Vanguard points that out.
All right, I just pulled up the information. The number one cause of murder in the world, ladies and gentlemen.
Yes.
Money. Close second? Come on, you know the answer.
I don't know the answer.
Sex.
Like bad sex or something? Well, that was really bad, so it's over.
Crimes of passion, infidelity, driven, stalkers.
Okay. Yeah, okay. That makes sense. Yeah, that's nothing to laugh about, but yeah, okay.
So
what's third?
Actually, no, they're almost the same. Oh, this is interesting. Premeditated murder, money's number one.
Yeah.
But when you throw in the emotional component of murder over sex,
Yeah.
it's slightly higher. So
So I guess we can't solve for that.
we can't.
Right?
Actually,
As
they're
an
the same.
advisor,
Money
that's
and sex.
an interesting advisor job there. So sorry. Can't. All right, let's see if we get to a few more of our questions. So
We have
thank
to do
you.
questions. We have so many.
I know we do. Ken writes us from Verona, Wisconsin. We're about a year ago, you and I were just there in beautiful
In
Wisconsin.
Verona?
I don't know about Verona, but we're in
Madison.
Wisconsin. Yeah, Madison. That's true. I heard on a podcast today that an annuity is not a good product to leave to your heirs.
No, it's not.
I purchased an annuity years before I knew they were not a good product and that they also carried high fees. I'm no longer with the broker who sold me the annuity, as this was probably 25 years ago. I've moved all my funds to Fidelity a few years ago. I rolled my annuity right over to a low-cost Fidelity deferred annuity, and we have $2 million invested in a fund, FB, V as in Victory, T as in Tom, C as in Charles, FBVTC.
FBVTC.
Yep. Okay. I did a direct rollover to Fidelity as I didn't want to pay taxes. I didn't need the money. Fee structure with this annuity is cheaper than it was originally. I'm paying 0.10% annuity charge plus 0.68 expense ratio on the fund itself. My question, now that my options this qualify, my question now is, what are my options with this qualified deferred annuity? If I annuitize, it will raise my income and I will pay a lot of taxes. Currently married, 63 years old. Do I leave this account to my two kids to deal with and pay the taxes? I love your show and your sense of humor. So
wait a minute.
Wow.
What was the fund? I kept looking.
I found it. It's F as in Frank, B as in boy, V as in Victory, T as in Tom, C as in Charles.
FBVTC.
I found it.
Okay, what is
It has
it?
an expense ratio of 0.73. It's a 70-30 managed portfolio using other Fidelity funds, it appears.
Oh, okay.
Yeah. But
Okay,
the question,
well-
that's kind of on the side. The question is what to do with all of this money that's in this
Annuity.
deferred annuity.
Yeah.
Right. I mean, should you just let it go on and, as he said, leave it to somebody else?
I am
Or what are you gonna
so tired. No offense, sir, to the author of the question, but I am so tired of the tax tail wagging the investment income doggy. You got tax deferred growth on this money for the last 25 years.
That's a long time.
Who cares who pays the taxes? Somebody's going to pay them eventually. And if you take out $1 and pay the taxes, you're still going to have 75 cents to spend that you didn't have before, really. This is fake money until you take it out and do something with it. So make it part of your portfolio and make it part of your withdrawal strategy.
But if he leaves that to someone else,
They're going to pay taxes on it.
yeah, there's no advantage. That's what I'm trying to get at. There's no advantage.
No tax advantage.
And whereas there would be in a regular brokerage account, for example.
Right,
Yeah,
right.
that would
And
be-
this is, by the way, not for this gentleman. This is for the rest of you who might be being pitched a variable annuity. This is one of the big downsides of a variable annuity is that when you take the money out, it is taxed as income. You get
Regular
deferral, but it's taxed
income.
as income.
That's right.
If you put the money in an ETF, a growth ETF, you might have a few income distributions along the way from dividends, but you're going to still get tax deferral on the bulk of your money because it's capital gains. Then you have two choices. You can either take the money out and you will only pay the capital gains tax on it, which is a lower rate than the income tax rate, or you can give it to your heirs and they will pay nothing.
By the way,
capital gain step up.
Did you get the estate tax amount correct on the recent tax test at the Wall Street Journal site?
I did. I went, it's whatever the highest number is.
Look at you, 15 million, I think
15
it is
million.
now. Yeah. So, anyway.
But you see, right now you can't do a thing because it's too late. Somebody has to pay the taxes. Who cares? Somebody has to pay them. Pay them. Enjoy the money. Do you really want to give it to your kids, or would you rather enjoy it?
All right, another question from
I'm selfish.
M in Squin, Texas.
Okay.
I think I'm saying that right. Tom and Don, I do appreciate all you do. I recently heard a commercial on a national channel that asked the question, if a house cost $30,000 1,000 Bitcoins in 2012, and that same house cost 20 Bitcoins in 2022 and 5 Bitcoins in 2025. Why does the cost in the U.S. dollar keep increasing for the same house? I thought about it, couldn't answer it, but figured you guys could.
Because the value of Bitcoin changed.
Yeah.
That's all.
I don't think there's anything spurious about this.
No, it's not. It's because houses aren't priced in Bitcoin. That's really why.
And by the way, you cannot buy a house with Bitcoin, I don't believe.
Directly? I don't think so.
No, you'd have to go
I don't think so.
Move it.
But here's the thing. That Bitcoin's not a currency. So you have to convert your Bitcoin into dollars. And back in the olden days when Bitcoins were cheap, it took a lot of them to get dollars. Now it only takes a couple to get the same amount of dollars. It's that simple. It's just that they're not a currency and they fluctuate a lot. I hate this stuff. I really do hate all of this.
You hate Bitcoin?
I can't believe that we're talking about it.
All right, letting it go. On to the next question. Jeffrey from Fort Drum, New York. Gents, JP Morgan, which seems reputable, is offering premium exchange-traded funds that give a high monthly dividend. The two ETFs in question are JEPQ, and JEPI.
Yeah, these are covered call writing funds.
Say I plan to buy and hold for 10 years and reinvest all the dividends back into these funds. What is the risk or likeliness of losing money? What are the alternative ETFs that provide a safe dividend that I could buy and hold for 10 plus years? First of all, I hate the expression safe. And when it comes to investing in equities of any type, any strategy.
Maybe I'm just getting old.
You should just throw out the word safe because they're not safe.
Maybe I am just getting old.
Covered call strategy, there's still risk to that.
Because, again, I feel like we just keep saying the same thing and nobody's getting it. We do not believe in buying investments for their income. We don't believe in trying to build an income portfolio based on high income investments because you can do it without getting complicated. The problem with a fund like this is that they're buying individual stocks or stock indexes. And in this case, they're buying individual stocks and then they're writing options. They're selling someone else the right to buy the stock. That limits your upside and turns some of that upside into an income stream. But it also dramatically raises your costs. Not only is for an ETF, 35 basis points is relatively high, but the internal expenses are going to be really high because they're constantly churning this portfolio and incurring transaction expenses that don't show in that expense ratio line.
Is it a safe dividend play?
No, because it works when it works, and then it doesn't at some point work. These strategies have been around forever, and they have their days in the sun, and then they fall apart. As a matter of fact, when I was a young broker person...
Oh, God, there goes the show. Okay, go ahead. I'm going to leave. I'll come back.
We used to sell covered call writing funds, and they worked for a while.
You were selling covered wagon funds. That's a whole different thing, I think.
Well, I wasn't that far back, but
sorry.
And these funds went away.
You're looking one up right now?
Yeah, I'm just saying when it went away.
All right, because I'm ready to move on to the next question. The answer would be no.
No, this is a silly idea. You build a total return. You quit. By the way, quit reading the media looking for the next hot investment vehicle.
Or as one advisor recently wrote, and I loved it, yield is for farmers. I think that says what you need to know. Susan from Tacoma, Washington writes, many thanks for everything you guys do. I'm a longtime listener and appreciate how you simplified investing for me. I have a question on bonds. I'm retired and 73 years old. My husband and I have maintained a 60-40 portfolio through retirement. That's 60% in stocks, I imagine, and 40% in bonds. Our bond portion is invested mostly in Vanguard Total Bond, Schwab Total Bond, and Vanguard Short-Term Investment Grade, and a small portion in TIPS. Our accounts are in Schwab, so we can readily see our gain or loss on each investment. Our bond funds are the only ones that show a loss since 5 years, or since the last 5 years. Why not invest in CDs or money market funds for the fixed portion of your portfolio? Won't those funds at least always guarantee no loss? Why bond funds for a portion for a fixed portion when they can too lose money? In other words, does it make sense right now to sell bond funds and buy CDs or money market funds?
Again, much ado about nothing. We have a lot of much ado about nothing questions. These are really out on the margins. You know, we're trying to squeeze out a little extra dividend yes.
Well, I'll say it first. Bonds have had a bad 5 years.
Yes. And bond funds are not as safe as a ladder of certificates of deposit as long as you're willing to do the work and maintain the discipline, just like any other part of investing.
And over the long haul, bond funds have made more than CDs. Over the long haul. Long haul.
But there's a reason for that. You can't.
There's more risk.
No. The reason is that over the long haul, you had the added impact of falling rates that was adding to capital gains.
You may have that again. We don't know.
Oh, I don't. But we expect the net effect from bonds to be neutral.
I expect bonds to return about 5% a year because that's what they've done for the last 100.
But again, not predicting the future rates. When we suggest fixed income, it's under the expectation of neutrality in value.
I think that's true.
Very little fluctuation. Bond funds, high quality, short intermediate term bond funds have very low volatility. Yes, the value can change a little bit, but you're unlikely to suffer major long-term losses because of new bonds always coming in to raise the rates. So, yes, you do have some volatility. For those who cannot stomach volatility in their fixed income portfolio, then there's nothing wrong with building a portfolio of CDs. The problem with trying to use money market funds is they sure look good today, don't they?
They do.
But what if rates go down?
Yeah.
What if rates go down? The bond funds are going to look great. You're going to regret not having a bond fund. If rates go down,
then you're going to write us and say, "Why am I owning the money market fund?"
Yeah, you're going to say, "Well, my money market funds went from 4 to 2."
Yeah,
but my bond funds, the value went up.
Yep.
You see, you're gaming, swit. I guess I'm really frustrated today. Everybody's trying to game the system.
Susan, it's okay to stay with the 60-40 and have the 40 be in bond funds. It's okay. Feel better now?
I don't.
Yeah.
I just feel like there's a lot of system gaming everybody is trying to just tweak the system a little bit to make more money, and that's not effective. It's a waste of your time and your energy.
Well, we talked to somebody recently who told us we're waiting to sell that stock till we make more money.
Really?
An individual stock. And I said,
really?
Right. Well, how do you know that? Again, that's gaming. That's hoping. So your portfolio, as you've said, should be correctly aligned for your needs and wants, not for hope of a bigger return. Thank you. Great answer. And by the way, we've gotten a lot of questions lately, and we'd love it if you keep them coming. It's easy to do. Go to talkingrealmoney.com, click on Ask a Question. But if you want individual help,
it doesn't say ask a question.
Ask an advisor.
No, that's meet with an advisor.
That's what I was going to talk about, meeting with an advisor.
Well, but you said ask a question.
So how do you ask a question?
Go to contact us.
Contact us.
Yeah,
I feel better now. So
you have never. Have you ever been to our website?
I didn't know we had one. So I thought this was a podcast or something. I just say the words.
You know where you put podcasts? You know where they actually live? They reside?
You know where you put a podcast? That's
you know where you can put this podcast?
Exactly. Sorry. So you want individual help other than just us talking about the question here on the program, and you want to talk to somebody, including myself, you go to talkingrealmoney.com, click on Meet an Advisor.
I'm sorry I was so grumpy today.
No, I was. Sorry. I think I was grumpier. Actually, one of my friends wrote me and said, "Are you okay?" I was like, "Yeah, I'm kind of harried."
No,
So that's how
I love all of you listeners, but darn it, would you guys please do what you claim to do? You say, "Oh, we just follow every word," and then, but wait, we're going to use a covered call writing fund to get a higher income, or we're going to try to game the bond market. No, stop. Build
Stop
the right
games.
portfolio. It doesn't have to be perfect. Good enough is good enough. This is like horseshoes. Close counts.
Horseshoes, hand grenades, and dancing, right?
Close counts in this game.
Okay, fair enough. You feel better now? You got that off your chest?
No, but I'll feel better later, I'm sure. Because
when you're done.
Every day we're doing what we're doing right now, which means I get another opportunity to be talking real money.
The opinions and views expressed on this podcast were current on the date recorded. Opinions, estimates, forecasts, and statements of financial market trends that are based on current market conditions constitute our judgment and are subject to change without notice, including any forward-looking estimates or statements which are based on certain expectations and assumptions. Although information and opinions given have been obtained from or based on sources believed to be reliable, no warranty or representation is made as to their correctness, completeness, or accuracy. Information presented on the podcast is not personalized investment advice from Appella Wealth. The views and strategies described may not be suitable for everyone. This podcast does not identify all the risks, direct or indirect, or other considerations which might be material to you when entering any financial transaction. Past performance does not guarantee future results, and profitable results cannot be guaranteed. We hope you realize that the information provided on Talking Real Money is for informational, educational, and hopefully enjoyable purposes only. The podcast is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Appella Wealth, a fee-only registered investment advisor. Please see Appella Wealth's ADV Part 2A on our website for information regarding Appella's fees and services. Appella Capital, LLC, DBA Appella Wealth, is an investment advisory firm registered with the Securities and Exchange Commission. The firm only transacts business in the states where it is properly registered or excluded or exempt from registration requirements. Registration with the SEC or any state securities authority does not imply a certain level of skill or training. Appella does not provide tax or legal advice, and nothing either stated or implied here should be inferred as providing such advice. Thanks for listening, and please visit TalkingRealMoney.com for more information and important disclosure related to performance of any specific index or fund quoted in this podcast. And the lawyers get richer.